So talk to me about the mill, okay? Because I want to kind of park it, because the interesting bit is the exploration, obviously, right? So most people are very excited about having a mill. Do you think, so tell us about the O3 option here. You know, are you literally dependent on what they decide to do? What are the terms? When does this option run out? You know, can you get rid of the option? Do you want to get rid of the option?
So it's quite a unique deal. So, and I think it's a good example of how to create value in this current market. So we aren't trying to I win, you lose, or you win, I lose. This was a win-win, a true win-win. Right now, we have access to 650 tons per day at whatever it costs, right? So relatively small mill, but works with the high-grade assets that surround it. There's 3 historic mines that surround it. All were relatively high grade, and that was very economic. Now, the idea was, when I was speaking with O3, was they need a place to process their material and specific permits for that. We have that, but we did not want to lose access to that 650 tons per day. Let's say that, so the river zone, for example, high grades, relatively close to surface, a few kilometers away from that mill, we can quickly ramp into that and start production. I didn't want to lose that infrastructure. So we were able to come up with an agreement where we maintain what we have right now. O3 has the option to expand or use that disturbed area for their purposes while we still maintain that access. So I think that is a great deal, quite creative. And, it's a 6-year term. We can still do custom milling in the meantime. They will buy us out of those custom milling agreements if we have one in place at the time. And at any time in the future when we want that 650 tons per day, we have access to that. So that from our perspective is a great deal. The other thing to keep in mind, we're an exploration company. There are costs to having that infrastructure. So we have to monitor the tails. We have to, maintain the site. We have to pay the insurance. There's a lot of things involved with that. It sounds, spectacular, but, until we have a custom milling agreement, it does cost us money. It is great for the future of something like a river target. But right now, this deal made a lot of sense for us, and I believe made a lot of sense for O3.
Okay, so is that why you think, a few months ago when you're at 5 cents and around 20 million market cap, the market was giving you zero value for the mill? It was more a liability than anything else. And you think you fixed that?
To be honest, I think that the market still doesn't give us a lot of value for the mill. I think that, if you look back at the share, at the market cap and what we were drilling at the time, you can kind of see what the market thought. So, when we first started drilling Bonifond, 200 meters of 1.5 grams to 2 grams, that's spectacular, but the market wasn't really into that at the time. So when we started putting out 44 grams over 6 meters, wow, that is something that they're into. And you can see the movements in the share price. We really have a menu, right? So we have, nice open pit potential with high grades to either side. There's a trend that's 5 kilometers long from Bonifond to that Bevcon asset that has multiple opportunities for Bonifond style deposits. So we have that in the menu. Plus we have these high grade projects in the menu as well. So we really offer a number of things, and we could potentially have cash flow. Custom milling agreements are challenging, and we don't want it to cost us anything. So it's got to be a cost plus agreement. And, it's difficult. If you're a developer, it's always challenging to raise money as a developer. And we've gone down the path a few times where it made sense and they didn't pan out in the end. But no cost to QMX, and nothing really changes. It's not our primary focus. It is a strategic asset that I would love to have cash flowing, but it's not where we focus our time. Our time is unlocking the value across this 200 square kilometer property right in the middle of Val-d'Or, surrounded by other exploration companies and producers that are putting out great results. And that's where that valuation gap, I believe, is going to close, is as we continue to do that. And it's big programs like we have this year, more than 35,000 meters. That's a lot. And we're going to be able to touch on a lot of targets in that and show them the potential.
We'll get onto that. With hindsight, would you have done anything differently with regards to your ability to monetize the mill? Could you have got other tolling agreements in there? Could you have got some revenues in other ways. I know when you're exploration developer, money's tight. You kind of have limited options, and you've got to pick not necessarily the best of a bad bunch, but you know what I mean. It's difficult. I do get that. With hindsight, would you have done things differently though?
I don't think so. I think that actually, had we been able to do the 03 transaction earlier, we would have done that earlier. They do contribute to some of those maintenance costs now and during the option period, so that's very helpful. We pursued opportunities to do custom milling where we thought it made sense, and there haven't been that many. And like I said, it really comes down to the juniors being able to raise money to put themselves into production in order to deliver that material to us. So I think that by setting up our agreements right from the start as cost plus, where money goes into escrow, anything being used comes out of that escrow account. There's never any cost to QMX. That really was a good way of doing things, and I wouldn't change that. Like I said, I would love to have cash flow coming from it. It's a great business, if you own the mill, but they haven't panned out. They are very challenging to put together.